Hello everyone, it's Professor Reiko here again, continuing on with our lessons on the debt securities, investments in general. We're starting with debt securities. That's what the last few videos have been in this one, and then we'll switch over to equity investments after that. All right, so we've gone through the classifications and the accounting for held to maturity, available for sale, and trading debt securities. So now what we're going to do is just look at it, what happens when we have more than one multiple years of adjustments and handling a sale. When we did the held to maturity debt security video, we did go through the how to sell that, and so we'll see how we handle it here. All right, so we have a company. They've got two debt securities, both classified as available for sale. And notice what we have here. So in the previous examples, we had the amortization table showing. Now we just have amortized costs. So remember, amortized costs would be the far right-hand column of those amortization tables. So somewhere for these bond investments, there is an amortization table, but we're skipping that now so we can speed up the process and get straight to the adjustments that have to take place. So remember, available for sale securities and trading for that matter, we have to adjust to fair market value on their balance sheet dates. All right, so we can see the fair market values next to it. And typically, if I have it presented like this, I'm just going to add on a column here for the unrealized gain or loss. All right, so we can see the first one has gone down in value. That's 1,975, and that's a loss. The second one has gone up by 1,045. All right, so if you have debt securities that are classified the same, meaning they're both available for sale, we can just combine that, and we see that we have a $930 loss overall. That means we can just do one journal entry to capture it instead of doing a journal entry separately for each one. Now, if you did two journal entries, one for each one, it would work out to be the exact same numbers, so that would be fine as well. But just to speed up time, especially when you're on a test, it makes more sense to combine things when you can. All right, so I said this last video, whatever number, I always kind of think of this unrealized gain or loss T account. Whatever number you calculate here, you want this to be the ending balance. Okay, so it's a loss. Losses are debits. And so I want 930 as my ending number. All right, my beginning balance, this is the first year, is 0. All right, so if I start at 0 and I need 930 as my ending debit balance, then I need to have a journal entry that debits this account for 930, and that will be my adjustment. All right, the journal entry then on 12/31/06 would be a debit, as we just said, debit to the unrealized holding gain or loss. And remember, this is available for sale, which means it flows through comprehensive income. So we put OCI for other comprehensive income, and that's 930. So once again, that is that 930 right there. The other part of the journal entry is the fair value adjustment, which is actually the account that adjusts the investment up or down in this case because it's a loss, to its fair market value. All right. Now look, your book will typically focus on this account, and that is fine as well. So remember, the fair value adjustment account, I kind of refer to it as what I call a companion account, and I think some of the books refer to it as that as well. But it works just the way the asset it's associated with does, meaning it's associated with an investment, which is a debit, normal debit balance, meaning we increase investments with debits and decrease them with credits, which means a debit to the fair value adjustment account means we're increasing the investment, and a credit means we're decreasing it. All right, so we can see in this one we have a credit. All right, so remember here, same thing, beginning balance is 0. We need to have a credit balance in that of 930 because it's a loss, meaning we're writing the asset down, which means our journal entry needs to have a credit of 930, and it does. All right, so that takes care of the first year. For me, like I was saying, I typically focus on the unrealized gain or loss over here because I'm calculating it right here, and it just makes it easier for me to do that. And you can see those two, these are always going to be mirror images of each other because they're the two sides of the journal entry. All right, so either one that you want to work with, do that, but just be consistent and so you don't confuse yourself. All right, so let's scroll down here. All right, so now we're going into the next year, and it says we're going to sell some of the bonds. We sell the ABC bonds. Okay, let me leave this so we can see that on July 1st, 2007. All right, so the bonds had an amortized cost of $88.10, and we sold them for $7,500. All right, so this is where things get a little bit different depending on what book you're using. All right, so I'm going to do it the way the Kiso book does it, and then I'm going to explain how the Spiceland book does it and kind of the differences and how that affects things. All right, so typically when you're selling something, you can just compare the sales price, $7,500, to the carrying value on the books for these, which we call amortized cost, which is $8,810, and that gives me my gain or loss. We're selling it for less, so we have a $1,310 loss. All right, so that means my journal entry is going to be, I'm going to debit cash, because remember, I'm selling something, so I'm getting cash for $7,500. I have a loss, and this would be like loss on sale of an investment or something like that, but just for the sake of space and time, I'm just going to put loss, and that's $1,310. And then we have to take the debt investment off the books. All right, we take that off at $8,810, so that is now zero. So the $8,810, but that credit takes the debt investment off the books at that point in time. All right, so a couple of things to think about here is if you're using the Spiceland book, all right, what the Spiceland book does that's different is they catch up the they catch up the unrealized gains or losses to the point in time where we are, which is July 1st. So they would first have a journal entry to adjust, to record the unrealized gain or loss and the fair value adjustment on July 1st. They then do a reclassification entry where they take it out of other comprehensive income. All right, and then they record the loss here. And so what it's doing, it's taking it out of comprehensive income so we can record it as realized loss in our income statement here. So it's definitely a lot more work. Kiso's point of view is let's just wait to the next balance sheet date and true up everything then. That makes so they both work out to where you're fine with you're getting the correct answers. The difference is Kiso takes it from the standpoint of the cost benefits of doing all that on July 1st isn't worth it. Let's just wait to the next balance sheet date, and then we'll catch up and true up the unrealized holding gain or loss count and the fair value adjustment account on that balance sheet date. All right, so I'm going to follow the Kiso book for this, but I do teach out the Spiceland book some as well, and so I do it that way also. So make sure you just are well aware of which book you're using and make sure you work through it appropriately. All right, so the next thing we're going to do is true things up at the end of that year. Okay, so we can see now that we only have the XYZ bonds left. All right, and once again, so here we have our amortized cost and fair market value. So I'm just going to add my unrealized gain or loss over here to the side, and we can see it's a $434 gain. All right, so let's do our unrealized gain or loss T account. All right, the difference is, remember, last period we had a loss, so that's our beginning balance this period. We now want a $434 gain. So remember, once again, the number we calculate there is the ending balance. All right, so to get there, we need 1364. All right, so yeah, that's right, 1364. All right, so anytime these two numbers are on the opposite side, like this is a debit and this is a credit, just add those together and that's going to be your journal entry number. All right, so my journal entry then is a debit to the fair value adjustment account for 1364 and a credit to the unrealized holding gain or loss account, and once again dash OCI for 1364. All right, that's that credit right there. And once again, we could have set up the T account for the fair value adjustment account if we wanted to, but like I said earlier, just make sure you are consistent with whichever one you use. I believe I talked about that in the last video. And then we could just keep going and going with this. If this problem had been changed to be a trading security problem, the only difference would be in our two adjustments that this would be dash net income instead of dash OCI. Everything else would have been the same. So I'm not going to do another example for trading because we're really just changing a couple of letters in certain parts of the journal entries. All right. So this kind of wraps up the debt security portion of the investment chapter. So next lesson, what you see, the next video, we'll switch gears and start talking about the equity investments, meaning we as the company are buying shares of stock of another company and holding it as an investment. All right. So once again, hope you're enjoying these. Please keep tuning in and subscribing and liking the videos. And make sure to share with your classmates as well if you find these helpful. Thanks a lot.